Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth. We're going to geek out today. It's been a while since I've wore these. You ready? Wow, feels weird. There's nothing there, so I can't see anything. Hey, we're financial advisors here with Jazz Wealth Managers, and occasionally we get a little bit nutty with data. We actually have now the ability to track any data point ever in history across the entire world, and so we want to start sharing information with you because why? The markets respond to abnormalities. That's the simple way to put it. If everything is behaving as it should, then the algorithms that all these companies use to trade and make decisions, they don't do anything. You ever notice how when something seems a little odd, the markets go crazy in one direction or the other? That's because the market's behaving outside of the average expected range or the average movement, right? So the stock market gets to be a little bit crazy when that happens. Well, we want you to know when the average is and what's going on outside of it so you can prepare ahead of time. And as investors, long-term investors, which is the accounts that we manage here at Jazz Wealth, we're always looking at that. Is everything as it should be, or did we do something outside of the average and we need to make an adjustment? So let's dive into it today. And to dive into it, we're going to get a little bit geeky. First, I need to set some groundwork here for you. The average range for October. Oh, and I'm going to use the fancy drumstick here today. So average range in October. I pointed this out in the closing beat just a little bit, but let's focus on this. So you got a stock market that's moving along, it's doing its thing, right? And you're tracking the average volatility. We want to know when to expect more volatility. You want to know when you should be okay with the markets going back and forth in a really crazy range. Well, if we put this here as January, we put this here as December, right? The biggest range from high to low happens in October historically. That's actually harder than I thought, so we'll put that over there. All right, so the biggest range is in October, averages 8.25%, meaning from high to low, you'll see the markets wiggle around, and if we were to wait till the month of October is done, look at the high, look at the low, the distance on average for the entire lifespan of the market is about 8.25%. If you come over here to February and December, so we'll use February and December, the average range in February and December tends to be a little bit lower, meaning there's less volatility. So if you were to look from high to low over here, you would find it's about 5% on average. Now, I don't know why February, to be honest with you. I know December is just because it's the holidays, right? So if in February the markets are wiggling around in a larger than a 5% range, something's off, something's wrong. We need to see what's going on. If that happens in December, then something's wrong. We want to see what's going on. It may present an opportunity because maybe we drop more than that and you say, well, historically that's outside of the norm. That may be a buying opportunity. Well, all other months, whether it's January, all through here, just minus October and December, the average is 6.5%. So the market basically moves within a range of 6.5% throughout its entire lifespan. We take the S&P 500, we go back to 1928. You look at every single month and the range, tally them all up, see what the average is, you get about 6.5%. So that's basically what you have there. Okay, so now we understand volatility. So these can come off. Let's talk about the start of October. Did you notice that the start of October was rather weak? So I'm in 2019 now, if you're watching this later in the future. It's 2019. First day of October, down 1%. By the second day in October, we were down almost 3%. How do we know that? We studied it. It was actually the worst move since 2009. I want to share that with you here real quick if I can. So here's a spreadsheet we put together real quick. The S&P 500. What we did is we said we want the month-to-date returns, and then we plucked out the first 2 days of October. So for example, this year already, the first day of October, the S&P was down 1.23%. By the second day, it had a cumulative loss of 2.99%. It didn't mean that it lost 2.9 on that day. It was just a cumulative loss by that point of 2.9%. If you go back to 2018, first day of October was a little bit positive. By the next day, we lost a fraction of a point. The cumulative gain was about 1/3%. You keep going back, trucking along. Here's 2015, 14, 13, 12, 11, 10, 2009. The first day of October was down negative 2.58%. By the second day, you could see it beat what just happened here. It lost 3.01%. And if you lived through 2008, you can kind of understand why that was a rough October. That was pretty much a rough year for a lot of people. We sort of understand that, and that's no big deal there. Now, here is the statistic to kind of follow from this. Let's go to the charts. As for October goes, Oh, I threw the stick over there. Sorry. As for October, when it falls more than 1% in the first day of October. So when we have a minus 1% or greater loss on day 1 of October, right? Now October, you could see on that spreadsheet I showed you, some days are not October 1st. It could be October 3rd. It depends on a weekday or whatever it is. So you got minus 1%. Whenever that happens, if you look back through the entire lifespan of the S&P 500, that has happened a total of 13 times. This would be the 14th time, but we don't know how the result of this October is going to pan out yet, so we're going to say it happened the last 13 times. If you look back at all 13 times when October started with a minus 1% loss or greater, 12 times we finished the year positive. We had a gain. What's that tell you? The first day in October really doesn't mean a whole lot, right? So as much as I want to try to make this something interesting, there's really not much I can do there. When I tell you that there's a gain based on a statistic, you always need to say, Dustin, based on what? Give me something. Give me an average. Give me some sort of add to that. So 12 out of 13 times after October was a losing day, 1% or more, the rest of the year saw a gain of an average of 2.22%. That's positive, right? So it's not a negative return, it's an average of 2.22%, following the 1% decline in October, right? So we compared that to say, is that any better than all the fourth quarters, right? Because what we're saying here is October. The first day in October is the start of the fourth quarter. So if it starts very weak and the rest of the year after that finishes with a really pretty respectable gain there, 7.22% from that day forward, then how does that compare to all fourth quarters, right? That's the study that we wanted to look at, and of course we have it here for you. So let's take a look. How does that performance back there compare to just an average fourth quarter? Let's just assume we don't pay attention to the October numbers. We just go, hey, we just want to know, how does it compare? I'm going to zoom in here for you. Zoom in a little bit so you can see these numbers. So what we did is we took every single cumulative return of every quarter and then we plucked out everything but the fourth quarter. So here we go. To give you an example, and I'm going to really zoom in, why not? If we said, okay, from October 1st through the end of the year, so this is telling you at the end of October, the market, the S&P 500 last year was down 6.94%. At the end of November, it was down 5.27% between the 2 months, so the cumulative return again. And by the end of the year, the quarter had returned minus 13.97%. So for the quarter, this is our focus number here. So we were just to kind of highlight that in orange. This one would be our focus. I'm not going to do it. I'm just going to say, I just want to show how that works. So the the fourth quarter of 2018 lost about 14%. Fourth quarter of 2017 gained about 6%. If we go to the fourth quarter of 2016, you got 3%, 3.25%. So we said, okay, how does that average up? We went all the way back to 1950 in this case. I'm just going to scroll through all of it. The average fourth quarter return is 2.43%. There's a lot of numbers getting thrown. Let's put these glasses back on, man. There's a lot of numbers being thrown at you here. So let's take a look. If the average fourth quarter is 2.43% and the average fourth quarter following a rough start to October is 7%, what's that tell you? We are well within average. We're not doing anything that's outside of the current average market movement right now. So there's really nothing to be worried about. Think about the stock market. The stock market is up 20%, the S&P. I'll just use the S&P. So with that data in mind, gone for now, we've got about a 20% gain in the stock market. So if the algorithms know the data that I just shared with you, which they do, I promise you they do, I've seen how this works, then we know that nothing drastic will happen unless we fall more than 13%. We got to give back 13% of our 20% gain, right? That's where the real action would start. So it means that we can technically afford a 13% drop in the stock market before anybody really panics, right? Because if we fall 13%, we would still be up 7% for the year, which would be well within expectations, right? Make sense? Hope that helps, right? Getting a little bit crazy today. So what you want to know when you look at these markets, if you like, I don't know what you were just doing, man. That was a whole lot of gobbledygook and I can't tell what's going on. At the end of the day, the stock market is still well within its average expected performance relative to its entire history. if you see people panicking about the markets wiggling around, it's actually okay. It also tells you that a 13% drop, well, really, we would just hope for like 10%. We don't want it to go test the limits of the outer bands of the expectations. But if we fell 10%, that really tells you that that's an opportunity rather than something to be scared of, right? Now, if we fall 10% and then we fall another 5, 6, 7%, okay, that's not so much an opportunity. Now it's a reason to panic, right? But for now, you now know that it's expected and okay if the markets fall. We'd still be within all the expectations there. However, even with a rough start to October, if the markets finish strong, that's also no reason to get excited because it's expected. It's within average. So we're within a cone of expectation right now, no matter what happens in the stock market. Unless we fall more than 13% or if we go higher by more than 7%, we're essentially within a range of expectation. All right, I'm sure I messed up something in that video. I was just trying to share the stats with you. Hopefully that helps. If that helped you in some way, maybe you'll hit the subscribe button. We always appreciate when you do that. More importantly, give me a thumbs up. Let me know if this is something you want to keep going with. If you don't like it, that's cool too. You can give it a thumbs down. It's all right with me. We will keep sharing more data with you if you're interested in it, and appreciate you watching. We'll be back later to do the closing beat, talk about data. We'll share a lot of data there. It cuts live at 5 o'clock Eastern Time on our YouTube channel, Jazz Wealth Managers, live on YouTube. So I hope you'll join us there and enjoy the rest of your day. See you.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.